Welcome to Laptop Radio. Today's topic is Intelligent KYC Management for Digital Finance. I'm with Matthew Unger, founder and CEO of iComply. Hello, Matthew.
Hi, thanks for having me.
Yeah, where are you located?
We are headquartered in Vancouver, Canada, on the West Coast. And
Awesome.
and then we have an office in Luxembourg as well.
Is it hot or cold there?
Out here, well, I was in New York last week and it was way colder than Vancouver. It's been not quite t-shirt weather yet, though.
Awesome. Yeah, I've only been to Vancouver when it's super cold.
It's been a good year so far.
Awesome. So tell us about yourself.
Yeah, so I guess, I started my career in finance quite a few years ago. I actually built a wealth management practice to about $42 million and sold it by the time I was 26. I then moved into more the technology side of the world, working in some of the larger financial institutions to try to bring technology into the field with their brokers or their advisors across the country. And worked on a project, actually a wealth management tech platform in 2014 that was acquired by Planswell about a year later. And so I've done a couple different projects over the years focused on trying to digitize finance. And I would say around shortly after selling the wealth management practice, it was 2010 or so, I heard about Bitcoin and really thought as a financial technology, it had a very interesting thing. And that kind of opened my eyes to where the future of finance would actually go. It just seemed like such a logical step as we move on in digitization of financial services.
And what is iComply?
Yeah, iComply is focused on offering institutional grade compliance tools. We focus mostly on things like AML, securities, related to financial services. But the big thing that we do for our clients is provide basically plug and play portals similar to Typeform or SurveyMonkey that handle a two-way compliance conversation between the back office rules and regulations and right into the client interface. So it really streamlines processes, allows clients to do very complex types of compliance, not just most cryptocurrency exchanges only require the compliance of a payment processor, which is one of the weakest standards, but anybody in the securities market has all sorts of additional things to do. So we try to really make that as streamlined as possible.
What are some risks with cryptocurrency?
Well, risk with cryptocurrency, there's a couple of things. One, we have cybersecurity risk. We have different, technological risk. Risk of things like 51% attack or different things on those lines. But then from a compliance perspective, you have to really understand how the technology works and how a blockchain does consensus could change whether that blockchain would be classified as a commodity or a security, et cetera. And so there's actually just how the technology functions can put what you're doing into a different regulatory bucket. And so there's a bit of a gray area risk almost. It's like, how do you kind of map this to the way the world works today? And then the other area is with things like money laundering or tainted Bitcoins. If somebody is part of a scam where a Bitcoin gets, they call a little old grandmother and get her to put a bunch of money into Bitcoin and send it to them, or they're going to send some police to go arrest her nephew. We see these things in Canada. People get these phone calls, these things happen in the newspaper. And so it's actually very important with the new regulations, like the FATF travel rule. There's a lot of risk for firms who take Bitcoin and don't know where it came from. Not necessarily the person, but what sort of activities, am I funding essentially by giving them cash for this Bitcoin?
So we talk a little bit about the risks of cryptocurrency, and I think a lot of people are really afraid of it. Sometimes they might not know it, or they might not know what it is. But there are good sides of cryptocurrency, and why is cryptocurrency groundbreaking?
I think there's a number of things. one is the control, the metrics of control, the dynamics of control, moving it, distributing it across the network so that it's technologically almost infeasible for a central power. And so these are the pure, like the public blockchains. And that's really incredible. I think it's not just about finance. You know, you look at things like Ethereum, where there's a lot of tokens are on Ethereum, a lot of people building financial services products on Ethereum. But in reality, the vision of Ethereum to start was essentially a global public utility computer. Like anybody could just, it's a computing utility that anyone can access. And that kind of allows people to build innovation as well, which you see in the cryptocurrency space. Once you've digitized these assets, you can start being very innovative with all sorts of new types of derivatives and things that just you could have done before, but they weren't cost effective. And by making the assets digitally native, you can do all sorts of financial strategies that couldn't have existed before.
And let's talk a little about KYC. KYC stands for Know Your Customer. But what does it mean in terms of compliance?
Totally. You know, it's funny because KYC is, it's not like organic, where there's a kind of a legal or regulated definition that you have to meet. So when you talk to somebody who works for a very traditional mutual fund, wealth management firm, KYC for them looks very different than for a cryptocurrency exchange. If you see a fund, let's say a VC fund, and how they onboard their LPs, they'll use a back office firm to do a lot of their KYC, which is filling out of a lot of forms to identify who you are, to make sure that you're not impersonating somebody else, to make sure that you're not potentially laundering money. There's all these different things that have to be done, and different industries and different jurisdictions have different legal requirements of what has to be done for KYC. So if you're doing a security token, as an example, that's being issued out of the US, onboarding US investors to the US standard is fine, but the second that you touch someone from Canada or Switzerland, you're not only you're understanding who your client is, the regulations about how you do that are different in Canada than in the US. And then what lists you have to check and screen are different by country. So we try to make that workflow, which firms like PayPal spent $30 million building a system in-house to do that. We make that accessible to a lot of these smaller firms, that fund administrators, back office firms, corporate services, to be able to do those same type of comprehensive KYC programs a lot cheaper than even the cryptocurrency exchanges can do it today.
Yeah, I am pretty excited about KYC. I know that a lot of different cryptocurrency projects don't like it, but I think for fintech, where there's a lot of fraud, I think KYC is the most important.
Mm-hmm. And it's what's interesting about it is that it's kind of a very critical component of understanding how to better serve your customers. So from a business perspective, knowing more about your customer is actually a good thing. A lot of these players, they want to basically transact with just Bitcoin addresses and be fully anonymous. And that's fine if you're doing that in a peer-to-peer basis. But if you're moving money on behalf of other people, it's important that they know who you are, you know who they are, because we've just seen a lot of shadow banking, a lot of scams that happen when somebody just says, "Hey, I can get you Bitcoin, and just give me some money and I'll come back." Well, it's actually really I think this regulation, and specifically actually the regulation that you see coming around the world for cryptocurrency companies called the FATF travel rule. So most people refer to it. And I think that is a data standardization requirement to the industry. It's how do you format a date of birth? How do you format a name, first name, last name first? And just getting the industry to agree on a common standard. Everybody's been so resistant. But when the industry actually moves to do that, you immediately have global infrastructure that allows you to operate within the current financial system. And so we can start using this technology to do more things within the financial sector. Whereas right now it's basically, new funds or funds or people tokenizing early stage companies that are, early stage technology companies. And I think there's a lot more exciting use cases out there, actually.
Let me ask you about AML. What is AML and how is that different from KYC?
So yeah, that's a really good question. KYC is knowing who your customer is. AML is kind of, think of it as an umbrella over that, where KYC is just one part of AML. So within AML, you have to know who somebody is, and then you have to understand what type of thresholds. So if the person is trading and a transaction is going through an investor from Europe, you may have to, if it's over 1,000 euros, you may have to file a report in that country. Whereas if it's in Canada or the US, you maybe only have to file a report if it's over $10,000. But most of these platforms are not filing these reports, much less doing it for the countries they're required to. And that's really what an AML program is. When you look at even a player like Coinbase, to manage their AML program, they have over 20 different APIs plugging in a whole team of engineers just managing their KYC system so that they can perform anti-money laundering screening for their users. So it's very expensive, it's very cumbersome and time consuming when you're trying to manage, when you have to hire a whole development team to kind of build a whole different system. And that's usually where we see a lot of the players in the fintech space. They understand KYC only from the perspective of filling out the form. They don't understand that they have to continue to check to see, if this person, as an example, were to be working an employee of Huawei and you're an American-based trading platform, you are legally barred from actually working with them when there's trade sanctions against technology companies like we just saw in the US. Most people's KYC system can't possibly even begin to identify those types of risk.
Yeah, and I'm also saddened by the fact that a lot of these projects hired other like AML firms, and they may not look at red flags for AML. Like they focus on some of the projects may focus on KYC, but they forgot about AML.
Yeah,
so it's kind of important to know that they're a little bit different.
Well, it's, KYC is where you gather it's really where you're gathering information to understand who your client is. And that's kind of, that's a lot of that process of making sure, if you, as an example, if you are doing a mutual fund based offer business in Canada, as an example, if you have a spouse, part of your KYC application is to say, yes, I have a spouse, and you have to put in their name. And that becomes part of the whole KYC process. Well, that's just not the same in other jurisdictions.
Yeah.
And so gathering that KYC is actually a complicated thing. But then once you do that, as long as you serve that client, and depending on the country, it could be 5 to 11 years after that client leaves your platform, you have to understand if there was AML risk. You have to be able to spot it. And that requires fairly sophisticated machine learning, artificial intelligence tools to do that at scale. Because as an example, if I was doing AML risk screening, so looking to see if you're on a sanction or a watch list, and I was going to search for my name, I may search for Matthew, but then I also might search for Matt and Matthias and Matteo and all these different variations. And that's literally how this is done by firms today. Or if it's a Bitcoin transaction, they're sitting on a screen and they're dragging and looking through a blockchain explorer to see if the money has touched anything negative or on a watch list. And so by automating those scenarios, what we do is we essentially, if there's no problem, if there's no risk identified, you can automate that section of the workflow. But if there is risk identified, you can immediately throw an exception, throw a flag to the compliance team, so that they're only paying attention to exceptions. They're not sitting there filling in forms and copying and pasting things between different screens.
How is the cryptocurrency sector different from the traditional finance space in terms of compliance?
It's actually, in function, it's not really, but in form, it may look a little bit different. So as an example, the travel rule with FATF, the all of the stock exchanges in the world run on a similar requirement called the FIX protocol. Everyone has to standardize their data this way. I think everybody in understanding payments and digital currencies probably is aware of the SWIFT network. And that's again a standardized JSON data file. And this is how you must format this data. That's all SWIFT is. That everyone agrees this is how we're going to do it, and we're going to use this network for it. And so I think as we see things like the travel rule coming in, it's kind of enabling. It's the same thing. It's just new for the industry. So I wouldn't say it's actually that much different. Your identification requirements are really the same. You know, how you identify somebody or how you identify a corporation. But then when you get into some of maybe the more nuanced things, like if I'm selling equity in iComply and I'm going and talking to a bunch of people that I know over the years who are interested in investing in my company, I get 10 investors, I raise, $5 million, and I know who these people are. There's not, and these shares in a startup might trade in 5 to 7 years. They might get an exit. And so a lot of these early stage investors early stage capital just isn't a good place to wash your money. But the second it becomes liquid, the second that you have the ability to get in and out, you all of a sudden have a very significant money laundering risk because the transactions are anticipated to be so much higher. You're going to move large amounts of investment capital. And so that really increases the risk and the required due diligence. And so I think that's going to be what's new for a lot of the players in the cryptocurrency space. I think when we talk to some of the players, even players like transfer agents or clearinghouse custodial services, they don't really realize the risk that they're taking on for themselves, their business, their shareholders, when they're accepting funds that were stolen, and they're saying, "Well, I'm just the custody guy," and so they're not necessarily aware that they have an obligation, but do they have any resources allocated to even identifying if they are banking a terrorist, essentially.
Mm-hmm. Yeah, I think compliance with KYC plus AML and security are pretty important in the fintech sector, especially digital currency or digital finance. And I know that iComply services security token. What is the difference between security token versus utility token? I know that's a really hard question.
Yeah, it's interesting. It's a very nuanced question. I think when I think of it, if I were to really, paint a picture in Crayola, a very, very oversimplistic way of looking at it would maybe be to say that I would see a utility token is the asset. The token is the asset itself. It's a digital good, or it allows you to redeem itself for a service. It could be a credit, whatever. The Bitcoin itself is the asset. Whereas in a token, it's representing a right into some other. It could be, typically some other asset, or even another right. So as an example, you could tokenize the equity in a company. Those tokens represent that you own, let's say, if you own 10% of the tokens, they say represent that you own 10% of the Class A shares of that company. And so that's, it's exactly the same word that we used before was securitization, where this piece of paper says that you own this. And now we're just using a much more secure and much more traceable type of technology than paper for these types of transactions.
For security tokens, there are a number of rights. They could be redemptive. They could have dividends.
Mm-hmm.
Do that sound very similar to traditional shares?
Mm-hmm. They also have some very cool ones that you wouldn't see in traditional shares because it's too expensive to administer. And with the token managing the cap table, most companies can, if you have the software set up to manage your token compliance, so the transfers, not just the identities of the people, but also the transfers, you can literally, you could have a form on your website that just says, if you're interested in investing in the company, these are the prices of shares right now. And maybe an existing investor will want some liquidity and be able to facilitate that. Literally at the click of a button for a board member to look at that and say yes, we're okay with approving this. And so you're that level of control is really where we see a lot of this going. I think when you get into that scenario and things are that effective, we've seen scenarios like life insurance pools from major life insurance carriers looking at tokenizing it amongst themselves just to ease the accounting because they don't have to reconcile their books overnight. And the token will do that for them. There's a lot of other applications to security tokens right now. You don't see a lot of crowd sale security tokens. Most of the clients that we deal with, it's a fund who's just, hey, we're gonna take this DocuSign, and instead of a share certificate after the DocuSign, your sub agreement, you're gonna get a token. Please enter your wallet in here. And now they've replaced all this infrastructure, lowered their cost by 95%, and they're running their business from a much more digital, in a much more digital, streamlined way. KYC is a real pain. If you've done it on paper, it's not a fun thing to do. You're sitting there filling out your name over and over again. You're like, couldn't we just make a sticker with my name and get, my name, my address isn't changed since the last 4 forms I filled out. And it's ridiculous that these are still manual processes in many cases. Almost all the cryptocurrency exchanges or even digital platforms today do corporate KYC still in a very PDF paper managed way. They aren't necessarily doing this in a digitally engaged way. And I think as we get the things like the KYC friction out of digital finance, it's going to make it so much more attractive. When you see things like coronavirus, which everyone's freaking out about, meeting people in public spaces now, why wouldn't your wealth manager, who you've been working with for 20 years, just send you a link to his website that says, hey, just put this stuff in here, and then immediately you're going to go straight into a DocuSign, and you're done. The whole transaction's done. And we see a lot of these applications really popping up now.
So is KYC important to both utility tokens and security tokens?
That's a really good question. It's a bit of an it depends. I'm not a lawyer, but I've been told that that's a good response.
Yeah, I think it's applicable to both. Personally.
Yeah. So from a security token, it's a security. You have an obligation already. Like it's pretty black and white. From a utility token, I think the way that the regulations and the guidance and the recommendations, all these different layers of things that become what your AML requirements need to be, it comes down to a phrase that they call a risk-based approach, which is really just, is there a risk that somebody could be using this? So, we've not only worked with companies to say like, hey, plug in KYC. We've also worked with companies like token issuers before who didn't want to do a security token. And didn't want they didn't want the regulator to see it as a security, and they didn't want it to have AML risk, so that they didn't have to do KYC on the people trading these non-fungible tokens. And we worked basically by changing how the smart contract, the transfer logic. And so this project specifically, the first project that we worked on this was CryptoKitties, and the logic of how a transfer is done. Of a token of a CryptoKitty from my wallet to your wallet is actually being facilitated by CryptoKitties wallet themselves, rather than going directly peer to peer. So it's going to be very hard for me to use this in a way to launder money. And so by just changing a transaction logic, they removed all this risk, and they don't need to spend all this money building and maintaining a KYC program.
Mm-hmm. So, and how about SARS? Is SARS important?
Yeah, if I speak freely on SARS, SARS they're very important. You could end up being criminally liable. Your large shareholders could be criminally liable. You have to report this, and it doesn't matter if you're like a laundromat on a street corner or a fintech platform. If your business has money laundering risk, you have an obligation to report. It doesn't say if you're a financial service business. And so I think a lot of platforms, they say, oh, well, I'm doing this other thing. We're just using cryptocurrency. And it's like, well, if this creates this risk, you still have this obligation. And so when you see things, you have to have a system that can see when that can spot a suspicious activity. That's the first thing, because it's a suspicious activity report. And then once you can do that, then you need to put that together. And ideally, most people on the platforms that we deal with, there's not a lot of things that actually require creating a SAR. But when you need that, you want to feed that into a tool that will um, do most of the work for you. You don't want to hire a whole team of people like the banks do to sit there and write up 20, 30-page SAR reports to report a $15,000 transaction that went through their platform. And then they PDF that and send it into FinCEN or the financial intelligence unit in their country. And so this whole process, it's very important. It's your obligation is there. As a process as a whole, it's incredibly inefficient because these PDFs that are coming in, it's almost impossible for FinCEN, as an example, as one financial intelligence unit, to see if 20 banks filed a SAR on the same person in one day. It can be very difficult for them to even notice this. And so a lot of these programs are right now, the governments are just starting to look at things like digital identity, which again is a major blockchain application. And they're starting to look at things like beneficial ownership of companies. And so all of that ties into who is the real identities of these people. And I think with those changes, with them digitizing those changes, I think we're going to start seeing SARs be able to be done by APIs a lot more. And I think the regulators, maybe, the regulations actually can be much easier to spot the exceptions than it is today. We estimate that we catch less than 1/10 of 1% of all money laundering because we just don't know what's happening in the background. And so rather than making it difficult for everybody, and then somebody in the background, is running a scheme, washing $170 billion from Estonia to Denmark, as an example, while everybody else is going through all this pain of sitting there filling out forms because of KYC, I think we're moving to a stage by shifting things digitally. We're moving to a stage where this is going to be a lot easier on the general person as well.
And with so many jurisdictions, since cryptocurrency is global, and each jurisdiction has different regulations on compliance, how do you think we could streamline the process so that compliance is easier?
That's a really good point. The regulation, the variation of regulations, if you look at them in basic buckets, there's regulations to say how you can verify whether a identity document is real. There's regulations that say how you can authenticate a user in a digital environment. And then there's regulations even about how how you're going to risk screen in this jurisdiction. What additional information, if there's any problems, what additional information you have to collect from the person. And so there's a report by the European Commission that came out last month that actually talked about this, where just to cover the European market, you would have to build 8 unique workflows, and in their workflow mapping, and the vendors they talk to would have to assemble 24 APIs. And that's now you're talking about building a whole software platform. And so that's really where we've focused on, is to say, rather than managing a slew of APIs that all do, this one does a face match, this one checks a document, this one, it's very complicated workflow, this one's doing blockchain forensics. We wanted to put that into a really streamlined workflow. And we basically have a widget that you just drop into your website and your compliance program is live. You configure it in the back end, and if you say we're going to start checking for the BC Securities Commission watch list, you just go into the back end, you click that, you hit save, and now you've added that new watch list to your environment. And so that's we wanted to make it like something like Salesforce was for CRMs, Bamboo HR did for the HR space, what Clio has done in the legal market. We really wanted something that would make things just so much easier for compliance teams to focus on the signals rather than the noise.
Do you think each cryptocurrency project should have a compliance person?
I think I hope not. Um, I hope that this is technology at the end of the day. If I use a Excel spreadsheet
Mhm.
and I decide to put my cap table on it, that spreadsheet is governed by securities law, by corporate law. If I put my marketing, customer marketing targeting list, it's covered by privacy law and anti-spam legislation. So it's the more the use of how you're using the technology. um, I hope that the second that you say the word blockchain, then all of a sudden you have like, you have to hire compliance officers, which are, you know, compliance officers are in massive demand right now because all these fintechs now need them, and they need to have at least 5 years of experience. And so, I don't think it's necessarily the right way to go. I think firms should talk to their legal counsel to identify if they see there's risk, and specifically not just looking at securities risk, but also looking at things like AML risk, and kind of addressing that side of the business, so that you can have confidence going to investors and saying, hey, we've structured this in a way that we think that we've managed these types of risks. Because the new investors, the new money coming into the space, is
Mhm.
very cautious and educated on regulation. And when you try to kind of, like a lot of people did in 2017, 2018, kind of BS a little bit and say, oh, it's this is an SEC approved Reg D offering. It's like, well, they actually don't approve these things. You can't really lay claim, where we saw Stephen Seacole like last week, or was it even earlier this week with the SEC? There's a lot of these platforms that the regulators are just starting to kind of do some crackdown with, and what in the last week, 2 cryptocurrency exchanges were put on a watch list because they were their KYC system wasn't the systems and their licensing weren't compliant with the jurisdictions that they were taking users in. And so, it's happening kind of on a global basis. And what a lot of the people investing in the space, when they're talking to us, they're trying to understand, where is the opportunity to, which potential investments are they working with that will have managed this risk better, that they can, that they know that this is going to be a long-term play. Because, if you're somebody like AirFox, who launches this whole program, and then when the market's down, the SEC comes in and starts throwing fines at you, it kind of throws a wrench in your entire project. So it's really good to take care of these things ahead of time. We had one client who just got approved for their cryptocurrency exchange to have Visa cards,
Mhm.
so people can spend their Bitcoin over Visa. That client had to go through audits with Visa, with their bank, with their regulator, in order to get that whole system live. And it's those types of use cases now where this company is going to be going public listing later this year, and they've taken care of all of these pieces now. So now they're ready to get down to business, rather than a lot of the people are kind of looking at compliance like, oh, we'll build that later on. We just want to get an MVP out, and they forget
Mhm.
that if you don't start with understanding what the compliance needs are, or what your potential obligations are, you'll have a very hard time jerry rigging something in later on, and kind of forcing a square peg into a round hole when you realize that your platform or protocol is functioning in a way that's creating some sort of regulatory risk.
Yeah, I see a lot of DeFi drawing or architecture that doesn't have compliance in it, and it just freaks me out. um, and it's amazing to see that, like, you cannot have and build a DeFi project without thinking about KYC, AML, and a lot of the compliance
Yeah,
having
and I totally agree. And if you look at the way anything is done in the traditional world,
Yep.
compliance is the thing that's usually slowing things down. The reason we had Trade Press 3 is that paperwork can get through the broker dealers. These By making this a much easier, like a much better digital experience, and giving that to our end clients, you're creating a huge edge on the competition. But you have to be still doing it properly. And so if you start with looking at understanding what is your business process of your exchange, and where do you want to plug the compliance in right away. You can launch with something at much lower cost than if you build something and then you go to a platform and you say, well, we did it this way, so now we need more customization. We're going to buy these 9 different APIs and try to assemble this and maintain a whole identity management system in-house.
What are some of your best practices for KYC management?
I think that's one of the things I think is, if you're not, when you're structuring your program, and because of the people who are looking at this from a digital assets perspective, you're basically looking at it as 100% digital delivery. People will onboard through your website. You're not going to have people, live agents, or humans signing forms or anything like this. And so when you're looking at it from that digital experience, I think making sure that the user experience is really clean, but also very, very early on, figuring out where you want to eject somebody from the workflow so that you don't spend additional cost doing things like running background checks on someone that you will never take on as a client because you don't accept people from their country. And you say nobody from this country. Well, if you look at most of these platforms, in order to get to that point, you have to submit all of this information. That runs into, if you take on information from somebody in Canada or somebody from California or somebody under GDPR, you have all this risk now that you've taken information of somebody that you can't serve as a client, and you have to make sure that you get that out of your system. And that just creates a headache. It's an administrative pain in the ass. So one of the easiest ways to handle that is to make sure that when you're onboarding people, that you're dynamic in your system to quickly identify, where is this person? Can we serve them? What KYC applies to them? And then immediately feed them into that one workflow, so that they don't have to necessarily come back and forth and send you emails and download an app to go verify their fingerprint and all this friction, because it's unnecessary. It's not regulatory required, and it adds additional risk into their equation. So the other thing I would say is make sure that you're doing proper risk monitoring. And when I think of sanctions and watch lists, most people, they're looking at a consolidated list. They're not actually looking at what their obligations are, and realizing that there's actually much more comprehensive things. And what do you do if you screen somebody today and then tomorrow they get put on a watch list? Are you going to be able to spot that in your system? So making sure that your risk monitoring is happening. In today's day and age, it should be happening on a daily basis. There's zero reason why you shouldn't just use technology to just auto refresh at this point, which is, compared to the traditional industry, they're doing that in every 3 months with a human manually searching things. And so, if you're driving this digitally, you can do it a lot better. I think the third thing would be, when you're looking at expanding across multiple borders, look at finding a solution. And this is, definitely something that we do at iComply, is finding something that's going to cover have as much coverage built into your tool into one tool as possible, rather than starting to get into this bloat where you have 8 APIs, 9 APIs, 15 different tools. See what you can do to kind of bring the workflow together, tie it into the rest of your customer experience systems, make it part of your brand, because this is a significant part of the client experience. And so those are really things that I think it's important to think about when you're putting these programs together.
And Matthew, is there anything that you wanted to emphasize that I haven't asked you?
I would say if people are interested in exploring this, what we see is that there's different players in the market. Some who are really looking to I just need to launch and get live. And so when you're doing that, you have to think of this, because if you're doing something regulated, scope your target market. There's no reason why your security token offering needs to be offered to 200 countries. You have a lot of legal fees if you do that. We had a client that did 104 countries. It cost them $1.4 million in legal. From each country, they needed lawyers to review things. And so, I think those costs are going to come down massively. We're seeing template tools coming into the market. But at the end of the day, for narrowing your scope to say, where do we actually see users on our platform? They're coming from UK, Europe, and the US. Okay, let's focus on just getting those 3 jurisdictions taken care of for offering documents, and then let's just reject people, or at least maybe not reject them from the offering, or sorry, maybe not reject them from entering your platform, capture them as a user, and then you may find that, wow, we have a lot of interest coming in from Dubai. We should maybe file, get some securities documentation together for that market as well. But you need to really think of this as part of your digital strategy as a whole. It makes a huge difference. If you narrow your scope, just know where your market is and target those players.
We haven't really talked about investors yet, and I know that your technology tracks the tokens so that it could be sold to certain investors. I know, and there's a rule about that. They have to be sophisticated. How do you guys manage that?
Yeah, that's great. So it's kind of done in 3 layers. So we have a protocol, and just for clarity, we have kind of 2 different products. We have our full KYC suite, and then, as you mentioned, there's some token management tools that you can layer on top of that as well. And so when you're looking at traveling, having people track, there's not just things like sophisticated investor, but what happens if I'm selling shares from a corporation, from a corporate investment account, often VC funds or corporates. And so if that's coming from a corporate account, your UBO, your KYC, who's behind that looks very differently. And if that person is behind 3 or 4 corporations, if one person is there buying up, 5-10% of your cap table, you need to actually see behind the corporate structures to identify, wait, we've now exceeded our corporate governance requirements, which says no one's allowed to own more than 5% without a board approval. Now the rest of your shareholders can sue you. And we've seen, massive amounts of lawsuits happening in the last, I think the 10x this year over last year, of shareholder class actions, different things like that against projects. And so, a lot of people don't understand it's not just, oh, look, I tracked these investors and tied these things together. There's a little bit of a bigger picture involved in making sure that you're looking at things like corporate governance. You're looking at things like, did this person appear on a watch list since their last transaction? And then, is this person allowed to buy or sell based on their jurisdictional securities law? And so every transaction, you need to look at the buy and the sell side simultaneously. And what we did was build an interface on top of the protocol, which currently only runs on Ethereum. And what that basically does is it allows you to manage the secondary transfers and build in automation around, if you hit none of these other compliance triggers, then just auto approve this transaction. If this person is already owning more than 5%, auto reject. And that allows for typically in the secondary transfers, over 90% of your secondary transfers can have fully automated compliance.
Then, Matthew, what is that one advice that you wanted to provide to the community?
It's interesting advice to the community. I don't know.
Or the community could be at Stanford or Bay Area or globally, since cryptocurrency is global. But it could be anything. It could be about entrepreneurship. It could be about compliance. It could be about building a project.
Yeah, it's interesting. I guess, I guess from an entrepreneur's perspective, I kind of look at this market like what it's the traditional finance market is in the final days of Blockbuster.
Mm-hmm.
And what digital finance has done and what tokenization has done so far, it has made Netflix DVD delivery. It's not digital delivery yet. And so it's when you actually look at what's left for this process to close, to have pure digital delivery, there's very few countries in the world that still require a handwritten signature on a document. Switzerland's one of the few ones. The rest of these, you have digital signatures that are enabled. You have everything that you need. So the companies that really become the first streaming services, look at Netflix compared to HBO. 15 years ago, nobody knew who Netflix was. Now they own this entire market. They're a household name. We literally, we have memes and verbs around their name, just like we have with things like Google or Facebook. And so, they've been able to do something that HBO's brand never could. And I think there's a lot of players in the wings right now that are really starting to get, they're getting their ATS or their MTF licenses for exchanges. They're putting the pieces together on the licensing side. They need to put their systems and tech, their compliance tech, their trading tech, whatever it is. They need to connect all those things. But we're getting very close. We see a lot of these projects going live later this year. And they're getting very close to the point where we actually now have fully compliant infrastructure available in multiple countries. And because they're using interoperable standards, there's some very exciting future possibilities. It's not going to be massive liquidity all of a sudden, all at once. I think we're going to see 5 years before things really hit that, that it'll just be silly for anyone to issue shares on paper. You'll obviously do them on a blockchain. And I bet that within 5 years, we'll actually see regulators requiring that you use a blockchain or, use some sort of permanent transparent reporting system for your cap table. I think that's something that we're going to actually, interestingly enough, see a shift that regulators say, wait, these tokens are really transparent, put everything on there. You have to, if you want to start up a company here, you have to tokenize your cap table. And I think we'll actually see that within 5 to 10 years.
And I'm not even surprised that the government use blockchain, just kind of like Edgar. I used to file these forms, and it's just a hassle every year to calculate people's number of outstanding shares and number of shares and report that.
Totally. Yeah, exactly. And when you have them in tokens, you're literally clicking a report to generate this stuff, right?
Yeah. And
very amazing.
Where can people find you?
Yeah, so check out our website, iComplyis.com. We can check out some of our products, blog on there on iComply. iComply is, or iComply IS on Twitter, Facebook, LinkedIn. For myself, I'm at Unger Matt, M-A-T-T, on Twitter. You can reach out to me there. And yeah, we love collaborating. We work in the security token market. We engage nearly daily in conversations with security token trading platforms, custodial services, issuance platforms, broker-dealers all over the world. And so we're really trying to do a lot to help to bring some of these communities together because we are getting close to kind of closing the loop on the back office, if you will. And I think that's going to be a period where we're going to start to see a huge amount of movement in this space.
Awesome. I'm looking forward to disruption in the compliance space and what you're doing, as well as the cryptocurrency space in general. Thank you for your time, Matthew.
Thank you so much. It was such a pleasure.
Bye-bye.